All right. Hi, everyone. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. How are you doing, Bob?
Hello, Katie. Good to see you.
You too. Busy day on Wall Street today.
A rough day. Yeah, a very
Yeah.
rough day.
All right. Well, let's get into it. So first up, rough day, like you said. So why is the market so upset by the new tariff announcements?
Well, it's upset because tariffs historically have been inflationary, and they've been a drag on the economy and a drag on earnings. It's really that simple. I mean, I know people in the Trump administration disagree, but history shows that it is. Um, Tariffs are taxes on imports, and they're passed on to consumers through higher prices. These are tariffs that are very broad, and it means a lot of things are going to be more expensive. On top of that, they often provoke these retaliatory actions by the trading partners, and we don't know what's going to happen, but it looks like Europe's going to do retaliatory, and you get this spiral where everything kind of becomes disastrous. I know people say, well, tariffs will help protect jobs. Well, I don't know. Sometimes they harm industries that rely on imported goods. It's not going to help the auto industry. I can talk to you about that separately, but it's very doubtful how many jobs you're really going to gain here or protect at this point. So I know you heard people in the Trump administration say, oh, there was huge growth in the 19th century when we had tariffs. There was growth in the late 19th century when we had tariffs, but the growth was not due to tariffs at all. We had huge technological innovations in the 1870s, 1880s, 1890s. You ever hear of electricity? That came in. That changed the whole world. The telephone came in. That changed the whole world. Technological advancement and improvements in productivity is why the U.S. economy expanded in the 1890s. It wasn't because we had tariffs at all. So that argument just, oh, there was some golden age when we had tariffs, just doesn't hold any water historically. So just think of it this way. Tariffs are inflationary, they're a drag on the economy and a drag on earnings, and that's what the stock market believes right now.
Yeah, you're certainly seeing that in the market today. So, Bob, you mentioned the auto industry, so let's dive a little bit deeper there. What do the new tariffs mean for the auto stocks?
Well, it's the same thing. Cars are going to be more expensive, and one of the main reasons is the labor is different here. So I'll give you an example. Our auto reporter, Phil LeBeau, shared this morning. Labor in the U.S. to build a car is about $70 an hour. To build a car in Canada, it's about $40 an hour. And to build a car in Mexico, $6 an hour. Think about that. $70 an hour in the U.S. versus $6 an hour in Mexico. That's a huge difference. You add in the difference in costs for indirect labor, and then electricity is more expensive and other things. And you can see why the automakers don't want to shut down their plants north and south of the border. It's simply more efficient to do them in other places. On top of that, there's no cars in the U.S. that are built with 100% stuff made in the United States. There is none. Even assembled cars here in the United States, a large part of the parts are overseas and subject to tariffs now. So the cars are going to be more expensive. Then you say, well, why don't we make them here? Why don't we make transmissions here? Well, because it's more efficient and cheaper to do it elsewhere. You can argue about let's do it here, but Americans generally don't want to pay higher costs. So you have a $10 T-shirt made in China. You want to make it here in the United States? It's a $20 T-shirt. You really want to do that? Is that an efficient use of our productive capacities? I don't think so. So you're going to see some effects here. I'll bet you'll see a rush to buy autos ahead of the tariffs. People aren't stupid. They're going to buy. Inventories will decline. So you'll get a sudden rush. If you look today, AutoZone sells auto parts. They were up. Why? Well, there's this sort of theory, it may be true, that this is going to cause so much chaos that Americans are going to keep their car longer, therefore they're going to need auto parts. It's an interesting theory, and they may be right on that. But you see this chaos that it causes? It's insane. It's amazing.
All right, Bob, I know you've been traveling in the last couple of weeks to a couple of different conferences. What were those conferences? Who did you talk to, and what were you hearing there?
I went to, this was before all this tariff stuff yesterday, but I went to Miami to the Future Proof Conference. This is a gathering of people who are in the wealth management business, RIAs, registered investment advisors, and some people in private wealth management. There's a whole industry out there that basically caters to wealthier Americans, say the top 20% or so. And they have concerns about these tariffs on top of that as well. Remember, virtually everything is going to be a lot more expensive. I also went to the ETF business, the ETF conferences in Las Vegas. The ETF business is growing. People are putting more money into ETFs. They're a better vehicle to work towards retirement on. They're more tax efficient. It's easy to buy into any industry. You can own the S&P 500 in a single stock. So that industry is growing as well. And what we saw there was significant money is flowing into gold ETFs. These are ETFs that hold gold in vaults and charge you for it. Gold's a safe haven. Significant inflows into bond ETFs. Bond's a bit of a safe haven. And a lot of Americans are getting older, so they want stream of income. They don't necessarily want capital appreciation. They want stream of income. And you see bonds today throwing off 4%, 5% interest. And a lot of people are interested in trying to figure out a stream of income as they get older. In addition to Social Security, what can they do without selling off their stock portfolio? So bonds are a really big thing these days, whether they're corporate bonds or treasury bonds or even money market funds. A lot of interest in that end of the business. So it's really very interesting watching where people are putting their money these days.
Yeah, definitely very interesting. And everyone can check out CNBC.com for some clips and more info from Bob's recent visits there. So next up, Bob, a question that we get pretty often, but it seems more often recently. Are we headed into a recession? What do you think?
Well, the recession is a sort of very broad word. I mean, technically, it's 2 consecutive quarters of negative GDP growth. Now, we don't know what's going to happen in the first quarter, but the Atlanta Fed has a GDP model, and they're estimating a contraction of about 3% in the first quarter. So that would be the start. It's not 2 consecutive quarters. We don't know what's going to happen in the second quarter, but that's certainly a start. Right now, going into March, I would say we had a normal garden variety correction. This is a decline of 10% in the market on a somewhat slower economy, but not a recessionary economy. And because of the thing that the market's really unhappy about is because of all of this tariff talk, you have a normal slowdown that's not a recession that could turn into a recession very quickly. And that's why the market is so freaked out. They believe tariffs is to sort of seek the extra sauce that's going to move us from a mild slowdown in the economy to a real recession. And I don't know the answer to that, but the market is trying to tell you that. One of the things you stop doing as you get older, I'm almost 70, I've been doing this 35 years, is stop telling the market what you think it should be doing. Don't yell at the stock market. Instead, look at what the market is trying to say and interpret what it's saying. And what the market is saying now is it's concerned that earnings are going to be coming down. It's concerned that the prices are too high and they're taking it down because they think earnings are going to be lower, largely because of what's going on with the tariff issues. That's what the market's saying right now.
So Bob, we're at the start of the new month. So are there any key market indicators that you think investors should be watching this month?
Well, I'll tell you what I watch is the earnings numbers. And the problem is, the whole problem with this tariff thing, as I said, is it's in a lot of circumstances, it's cheaper to make things overseas. And that's generally good for profits in general. So if you reverse that, you're going to have higher costs. Things are going to be more expensive, but you're going to have lower earnings. And the market hasn't fully priced that in yet. That's why you're getting this freak out in the markets. Second, the multiple for the market is way too high. So I'll give you an example. In 2025, we're expecting record earnings for the S&P 500. The total aggregate estimates, dollar estimates for the S&P 500, the 500 biggest stocks, is expected to be at a record in 2025. Overall, we're expecting to be up about 10% in earnings. And in 2026, that's a long way off, but we're expected to be up about 14%. Well, that's not going to happen with tariffs. There's no way it's going to happen like that. That's going to have a real negative income. I don't know if the real number is up 5% or 7% or flat or down. We don't know yet, but it isn't going to be those kinds of levels. It's not going to be up 10%. We're even close to that. And then there's the PE ratio. The PE ratio is how much you're willing to spend for $1 of earnings. So right now it's 21. So right now you're willing to spend $21 for $1 of earnings in the S&P 500. The historic average is about 17 times. So the market is very rich. The multiple is very high. We're paying a lot of money 21 times for $1 of earnings. That's well above the historic average. That's not going to happen either. If we go into a recession, that number could go to 14, 15 from 21. You know, instead of 5,500 on the S&P 500, we could be at 4,500 very easily. So you see what's going on here. There is pressure on the earnings expectations now because people didn't believe that these tariffs were going to actually happen on this level. Number one, they thought they'd be negotiated away. And number two, they didn't think they were going to be this high. So maybe down the road they will be, but this is causing a lot of chaos. And the crazy thing is all of it is because of it. The vast majority of it is because of the tariffs. And it could change because of a tweet. Now, doesn't that sound amazing to you? That all this could go away with a tweet? It does to me. It seems everybody else in the market seems to feel that way.
Well, definitely something we'll be watching very closely in the coming weeks. And then, Bob, our next question is specifically for retirees. If you're a current retiree, what should you be doing with your investments?
Well, you know, we've talked about this for years, and what the pros say is very simple. You have to have a mix of stocks, bonds, cash-like instruments like money market funds, and maybe some real estate. And what is the right mix depends upon your comfort level. I have a very high tolerance, and I've published what I own. It's in my book, folks. Shut up and keep talking if you want to see it. But there's a chapter where I describe what I own, and my mix for years now has been about 75% stocks, my 401k, 20% bonds, and 5% like a money market fund. It's run somewhere around there. That's high for somebody my age. I said I'm almost 70, but I have a high tolerance. My opinion is I'm going to live for another 20 years, live until I'm 90. And 20 years is a long time. What happens in 2025 isn't going to be that important in 2045. So I'm sort of banking on that. Now, other people may be uncomfortable. They may say, I only want 60% or I want 50%. Well, then that's what your comfort level should be. The one thing I could tell you is people in my age group are definitely more interested in getting some kind of steady stream of income. Like, how do you convert all the money that's in your 401k into some monthly stream of income, like Social Security is? Social Security is a monthly stream of income. Well, how do you take some of your other assets, like stocks and bonds, and convert it into a monthly stream of income? That's of great interest to a lot of people. That's one of the reasons people like money market funds, because it's a simple way to own a steady stream of income. And we talk about this and how to do it all the time. So I perfectly understand. And in my ETF Edge show on Monday, I'm going to be interviewing some people who have new ways of getting regular streams of income from bond funds, monthly streams of income. So if you want to watch, etfedge.cnbc.com. That's Monday at 1 o'clock, etfedge.cnbc.com. It's going to be a very interesting show.
So, Bob, kind of the flip side of that question, if you're a new investor, what should new investors be investing in?
If you're 20 or 30 years old, there is nobody who would disagree with me that your core holding should be a stock fund, and the S&P 500 in an ETF is the easiest thing to own. There are many different ways to own it. One symbol is SPY, another is IVV, another is VOO. They're all the same thing. It's the S&P 500. That should be the core holding. It's my core holding for decades. And why wouldn't it be? You own the biggest 500 stocks in the United States. If you want to add a international fund, go ahead. If you think you're a genius, go ahead and try to pick something else. But you're going to find, in most circumstances, you are not going to outperform the S&P 500. It's extraordinarily difficult to do that. I don't mean on a daily or monthly basis. I mean over many years. I would be amazed. And in general, I know you'll be shocked to hear this, it's very risky to own individual stocks. They just are. It's too volatile. You want to own the broad market. And I know people who said, oh, I'm diversified. I own 10 stocks. That's not a diversified portfolio at all. You want to generally own index funds. Now, the old recommendation used to be, this is Jack Bogle's advice from the founder of Vanguard, if you want to scratch the itch and think you're a stock picking genius, go ahead. You got $1,000, take $900 of it, put it in an index fund like an S&P 500 ETF, and take the other $100 and go ahead and buy something, NVIDIA or whatever you think is going to outperform. But watch how it performs against the S&P 500. And if you watch over a long period of time, you're probably going to find that when you add in costs, including the time you're spending doing the research, you're probably not outperforming at all. But people want to scratch that itch. They think they're smarter than everybody else. And they think that people who start out in the market like to engage in lottery-like behavior. They think that this is gambling, and it's not. The stock market, long-term, is an investment. It is the opposite of a casino. It is not a casino. If you want to bet daily on the stock market, that's a casino-like behavior. That's not a good idea. But long-term, think about this. Long-term, you put money in the S&P 500 and leave it there. Historically, it's gone up over the years. Historically, there are years where it hasn't, but the trend has always been up, always, long-term. In a casino, you put money down on a daily basis in a casino, you are designed to lose. It is set up for you to lose because you must pay the vig to the house. They get a cut every time. And it's designed long-term for you to pay them money. If it wasn't, they would change the odds. That's the whole point. So a casino, you are designed to lose money. It is a negative sum game. In stock investing, long-term, you are designed to make money. It is a positive sum game because the pie expands. And this is something some people seem to have a hard time grasping. They just say, oh, it's all gambling. No, it's not. It isn't. And understand the difference between gambling and investing. And that's when you will start making real long-term wealth. I figured this out 35 years ago when I first got to CNBC, and frankly, had almost no savings. I was 35 years old in 1990 when I was hired. And boy, you got a real education being at CNBC in the very, very earliest days there. That was quite an education in the first year at CNBC in 1990. And I learned very, very quickly that a lot of things I thought were a good idea, like gambling on the stock market on a daily basis, were stupid ideas. And I haven't seen anything that changed my mind since then.
Well, I think that's really helpful for a lot of people, Bob. Our last question for today, something that we get a lot of questions about, is AI. So can the AI boom last? What do you think?
Well, it is lasting. It is going to last. Of course it is. Just like the software boom 20 years ago lasted and made a lasting impact. It's going to change the world. It is changing the world. The question I think you're asking is, will it generate tons of profit and make the stock market go up big? And there I'm not so sure. It's absolutely going to make companies more efficient. It's going to make your life more efficient. I'll give you a simple example. How many people have been frustrated with call centers? You call into the telephone company or the cable company and you get a voice operated robot and it doesn't do what you want it to do. And then you have to ask for a real person and they don't do what you really want them to do. AI can really help improve all of that. I anticipate within the next 2-3 years, AI-driven assistance will make call centers almost obsolete. I hope so. If you can't do that, then AI is a failure. That's what you want. When you say, I want to stop my subscription to this and that cable service, and they'll say, they know how to do that. It's just hard to get at. And they say, yes, I can do that right now. That's what you want. So that makes your time more efficient. It makes the company's time more efficient. There's going to be countless examples of where AI is going to make people more efficient. Now, people say, will somebody lose their job? Yes, but this happened 20 years ago. Remember, there used to be people had bookkeeping on paper, and they used to have books. That's all gone. People don't do that anymore. Well, what happened to all those people? All those people who were bookkeepers that wrote down in books and kept it on a shelf because they ran the local bank. They got other jobs. When I got to college in 1974, I was a part-time telephone operator. You know what that meant? It means that there was a wire into the building And to get to the last wire into people's rooms, you had to pull a wire out of the wall and plug it in to the room. I was a telephone operator. That was one of the biggest jobs in America in the 1930s, 40s, 50s, and 60s. By the time I got there in 1974, it was a dying job because my building was really, really old. It actually had a telephone where you came in and you had to plug it into the wall to get into you had to plug the wire went into the building, but not into the room. So the last mile, you had to plug it in to the connection to get it to ring in the room. What happened to all those people who were telephone operators in the 30s, 40s, 50s, and 60s? Where did they go? They got new jobs. But nobody, objected, saying modern technology was going to eliminate the telephone operator job. But it did. And people found other jobs. Now, the argument is, well, AI is broader than just that. And it may be. But all I can tell you is the only way to sort of keep moving is to figure out how to make things more efficient and more productive. And I'm quite convinced AI is going to improve productivity and it'll make life easier. I don't know about you, but I find technology horribly frustrating. I spend a lot of time trying to figure out technology that I don't understand, or it doesn't work the way I thought it was going to work. I mean, it's still ridiculously difficult to operate a phone. I mean, how many of you just can't figure out, how to get your email in a certain spot or to do something? Aren't you frustrated all the time doing that? Don't you wonder, like, why is this so hard? Why can't I get somebody on the phone? Why can't I get my software to work? Why can't I do this stuff? And so I think technology is wonderful, but terribly frustrating and difficult, particularly for older people. AI has a possibility to change all of that. I don't want to go to Apple Store and try to figure out how to get a new email all the time. It's a pain. I'd rather just have my AI do it, Bob AI. And you're all going to have your own personal AIs in the next few years. Boy, does that make me happy. I don't want to go spending my time trying to go through software manuals or ask ChatGPT how to do this upgrade or that upgrade. So you should be optimistic about things. And I'm not even talking about the improvements in healthcare that are going to be coming from AI. I know this is a cliche, but curing cancer, curing Alzheimer's, it's not such a crazy idea anymore. It's going to be wonderful. So I'm always a techno optimist. Yes, some people will lose jobs, but think of the telephone operator. My job went away when I was a telephone operator. And just people who wrote on books, ledgers, who were bookkeepers, their jobs went away too. The software today does that. There's nobody writing in books, keeping ledgers on a shelf anymore, unless you're running a pizza shop. So my basic message is be optimistic about the future.
All right. Well, those are all of our questions for today, Bob. We got a lot of great questions, so thank you to everyone who sent in them. And I know it's been a busy day, so thank you for taking the time to answer all of those.
Yep, we will get through this. Be optimistic. Thank you, everybody. Great question.
Thanks.